Looking at example problems for Chapter 23, which covers flexible budgets and standard cost. This first problem is going to have us preparing and analyzing a flexible budget. So we are working with Phoenix Company that reports the following fixed budget. Okay, and by a fixed budget, what we mean is it is based on one level of sales volume. It was based on expected production and sales volume of 15,000 units. Okay, so they had planned on selling 15,000 units, expecting sales of 3 million, these costs and a net income of 159. What we're going to need to do is recategorize all of these costs by their behavior. So the first thing we're going to do is, let me see if I can get this all over here so it's not cut off, classify each of these items on their budgeted income statement as variable or fixed. And for the variable costs, we will then need to determine their amounts per unit. Okay, that's information we will need to prepare a flexible budget. Okay, for fixed costs, we will determine their amounts for the year. Okay, so going down these costs, we're going to classify each as variable or fixed. Okay, sales obviously is variable, right? Sales will vary based off of the number of units sold. Direct materials, those costs are variable. In total, direct material costs will change as the level of sales changes. Same thing with direct labor. Again, another variable cost. More sold, the more the labor goes up. Sales staff commissions. Commissions are going to be based off of sales, so that is going to be variable, right? As sales change, the commissions will change. Depreciation on the machinery. Depreciation is a set amount every month, right? It's not based off of how much is sold. So depreciation is going to be fixed. Supervisor salaries. By definition, salaries are a set amount each month or each year. They are not variable, they are fixed. They will not change regardless of the level of sales or the level of activity. Shipping. Shipping is going to be variable, right? Because the more units sold, the more our shipping costs will change. Sales staff salaries, again, they're telling us this is a fixed amount, right? This is not commissions, this is their base salary. This is fixed. The commission portion is variable. Administrative salaries, again, salaries are fixed. Depreciation on the office equipment. Again, depreciation is not going to change as the sales levels change. All right, so what we have now done is we have reclassified all of these into variable behavior and fixed behavior. Now that we have come up with the totals and classified them, to get the cost per unit for the variable, we're just going to divide each of these amounts by the sales volume that these amounts were based on. Remember, the revenues and these expenses were based on selling of 15,000 units. So if I take total sales and divide by 15,000 units, selling price of $200 per unit. Total direct materials divided by 15,000 units, direct materials are $65 per unit. Labor divided by 15,000, $15 per unit. Sales staff commissions, 60,000 divided by 15,000, $4 per unit. And shipping, $225 divided by 15,000 units. Shipping is $15 per unit. Every unit is sold for $200. Each of those units sold incurs cost of $99 a piece for variable cost. And then each unit sold will help contribute towards covering these fixed costs. Having the per unit amount for our variable costs will make preparing flexible budgets super easy. Essentially what we're doing is we're taking the original, what we call the static budget, and we are going to prepare a budget for 2 additional levels of sales. We're flexing this original budget to sales of 14,000, and sales of 16,000. And it's super easy to do. We know that each unit is sold for 200. If we sell 14,000 units, $200 times 14,000 units, we are going to have sales of, let me make this a little bit smaller so we can get it into one screen, 2.8 million. If I'm preparing a budget for 16,000 units at a budgeted selling price of $200 per unit, we are budgeting sales of 3.2 million. 16,000 times $200 per unit. So in addition to having a budget, if we sell 15,000 units, we budget 3 million in sales. We also now have a budget for 14,000 units. We would expect to have revenues of 2.8 million. And if we sell 16,000 units, our budget is for 3.2 million. Take a step back, big picture. Remember, all we're doing here is we are preparing additional budgets. We're using the budgeted amount per unit and multiplying it by the budgeted level of units. Okay, we're going to do the exact same thing for our variable cost. And remember, these numbers are just coming directly from our calculations above. Multiplying each of these times 14,000 units, come up with the variable cost incurred for a budget of 14,000. 16,000 times the variable cost per unit budgeted, come up with total variable cost for a budget of 16,000 units. Revenues minus their variable cost, contribution margin. Then we need to subtract out all of the fixed cost. And remember, these costs are fixed. They are not going to change whether it's a budget for 15,000, a budget for 14,000, or a budget for 16,000 units. These costs will not change as the level of activity changes. So those amounts are going to be the same for our 14,000 unit budget and our 16,000 unit budget. So now I have my contribution margin less my fixed cost. I now have a budgeted income for 14,000 units sold, 15,000 units sold, and 16,000 units sold. All right, the last item here, the company's business conditions are improving. One possible result is a sales volume of 18,000. We're going to prepare a simple budgeted income statement if 18,000 units are sold. So we have all the information we need. 18,000 units at a selling price of $200 per unit, 3.6 million. Our variable costs per unit are $99. 18,000 units times $99, variable cost of 1.782. And a contribution margin of 1.818. Fixed costs will be the exact same, right? Because they are fixed, they're not going to change. Fixed costs of 1.356, net income of 462,000. Okay. So what you can see is flexing a budget is fairly simple to do. All you need are the variable costs per unit and then break out the fixed cost. One of the benefits of using or preparing a flexible budget is to be able to have a better comparison of actual results. So what this next problem is going to do is we are going to work with the information for Phoenix Company, the company we were just working with in the previous problem. What they're telling us is that they reported the following actual results. Actual sales were 18,000 units. This were their actual net income and their actual cost when they sold 18,000 units. And they want to know, how did we do? Well, remember, the original static budget was based on 15,000 units. So if I compare the original static budget for 15,000 units to results that are 18,000 units, a lot of these numbers are going to be, I'm going to expect them to be very different. But it doesn't really tell me a whole lot because I'm comparing apples to oranges, right? And I want to compare apples to apples. So what I need to do is compare my actual results in my performance report to a budget that is based off of 18,000 units as well, right? If I'm comparing actual results and a budget that both were based off of 18,000 units, it's going to make it a lot easier to evaluate performance. So, pulling my flex budget, I had prepared this kind of big picture budget of 18,000 units, $3.6 million in revenues. Now above we didn't do the 18,000 unit budget on a line-by-line basis, but to prepare a flexible budget at 18,000 units, we're going to multiply 18,000 units actual by the budgeted cost per unit. So if I multiply 18,000 times 65, direct materials would be budgeted at 1,170,000 for a budget based off of 18,000 units. Direct labor, $15 per unit times 18,000 units actual results, 270,000. Okay, so what I'm doing is I'm just multiplying those variable budgeted amounts per unit times 18,000 actual results to get my total variable cost. Budgeted revenues less variable cost. Variable cost for 18,000 units leaves me with a contribution margin of 1.818. I need to subtract out my budgeted variable cost. To get my total fixed cost. Contribution margin minus my fixed cost gives me my income. Now I'm going to bring over my actual results. This was the actual revenues when 18,000 units were sold, actual variable cost, actual fixed cost. Now to evaluate performance, I know I am comparing a budget that is based off of the same level of sales as my actual results. Now I can go line by line to evaluate the variances. The variance, or the difference between the budget and actual, was $48,000. 3,600,000, difference between that and 3,648,000, 48,000. The actual results were greater than the flexible budget by $48,000, and that is favorable. We want our actual revenues to be greater than our budgeted revenues, right? That's a good thing. Now let's go down here and compare direct material cost actual of 1,185,000 and my budget of 1,170,000. There is a dollar difference variance of 15 grand. My actual material costs were greater than what my budget says they should have been for selling 18,000 units. That is unfavorable, right? Because we do not want our cost to be higher than what we planned. So when the actual exceeds the budget for our expenses, that's unfavorable. It was favorable when the revenues actuals exceeded budget, right? That's a good thing, but when costs exceed budget, it's unfavorable. Line by line, I'm determining the dollar difference and identifying each variance as favorable or unfavorable. Expenses greater than budget, unfavorable. Expenses less than budget, favorable. Expenses less than budget, favorable. Okay. Contribution margin. Actuals exceeded budget. That is good. A contribution margin is a good thing. The bigger that is, the better. So that is favorable. Down here, there was no variance in the depreciation cost, but all three of my other fixed costs that had a difference, all of those fixed costs exceeded the budget, and those were all unfavorable because our actuals were greater than our budget. Okay. In total, my income actual exceeded what I had budgeted for selling 18,000 units, so that's favorable. Okay, stop and think about the benefits of this. If we had compared actual results to the original static budget that was based off of 15,000 units, it would not have been good, right? Because we would have been comparing things based off of an entirely different level of sales. So by comparing two amounts that are based on the same level of activity, we've removed any cause of the difference as being the difference in the level of sales. So it allows us to kind of isolate on the actual cost. Okay. So what do we do with this? Well, this is where we would go to the employees and say, why do we have this variance, right? Not only are we going to focus on the bad things like, okay, production manager, why did our material costs, why are they so high? Right? Let the production manager explain. Maybe there's a good reason. Maybe it was out of their control, right? Maybe it was just a one-time issue. Or maybe we need to use this report to help us determine what changes need to be made moving forward to control our material cost, right? Maybe we will also focus on the good things, the favorable variances. We had a favorable revenue, sales. Go to the sales staff. Why are we so high? Why are we so far over budget? That's great. We can sell our inventory items for more. That's wonderful. Let's keep doing it, right? So this helps direct management's attention to both good and bad things in our operations that we may want to address. Okay? So that's what these performance reports are used to do. Right, those flexible budgets and performance reports, we're looking at results in total for the whole company. We also may want to know how the company did on a per unit basis. Like, how did we do when we were producing the inventory? Did we stay within our budget, right? So we can come up with standard variances as well. And a standard is just a budget on a per unit basis. So think of it as budgeting per unit as opposed to budgeting in total. This exercise is going to have us working with this company, and they are asking us to prepare a standard cost card, compute total budgeted cost for the month's production, and then compute the total actual cost, and then compute the variances. Okay, so let's take a look first at computing the standard cost card. And a standard cost card is going to determine what is it going to cost us to produce each unit of inventory. Three costs are incurred to make inventory, right? Three things go into making inventory: materials, direct labor, and overhead. Direct materials. The company's standards are to use 6 pounds of material at a cost of $8 per unit for each inventory item. Standard direct material cost per unit, $48. Direct labor. Standards are 2 direct labor hours at a standard direct labor hour rate of 16. Direct labor standards are $32 per unit produced. Overhead. Standards are 2 labor hours at an overhead rate of $12 per labor hour. Our standard overhead cost per unit, 24. We now have a standard cost card. Material costs per unit, direct labor costs per unit, and overhead costs per unit. Every unit produced should cost $104. From that, we are able to then do budgeting on a bigger scale, right? Once we know what the standard is per unit, then we can budget what the total budgeted cost or expected cost will be for June production. 8,000 units are manufactured, 8,000 at a standard cost of $48 per unit, 8,000 units at a standard cost of $32 per unit for labor, and overhead at a standard cost of $24 per unit. Total budgeted cost for each inventory item produced based on our standards, $832. Now they want us to calculate total actual cost for June production. And they gave us the actual results here. Actual amount of materials at an actual price, actual quantity at the actual price, direct labor, actual hours at the actual rate paid for our labor, and our actual overhead cost. Which, to be honest, I'm not entirely sure where that number came from because it wasn't directly given in the problem. It should have been, but let's assume that they had told us that our actual overhead was 198,000. Okay, so now that we have our total actual cost and we have our total budgeted cost, they want us to then compute the total cost variance for the month, right? The total cost variance in total is going to be the difference between the budgeted cost based off of standards and the actual cost based off of the actual results. So we just need to compare total actual cost to total budgeted cost based off of standards. So what we have here is we have a total cost variance of 17.9. But if we stop and think about this, this doesn't really tell us whether the cause of this variance, which is unfavorable by the way, because our actual cost exceeded what our budget says they should have been. But this doesn't really tell us the cause of this unfavorable variance, right? We don't know whether this unfavorable variance is due to the price we paid for the materials being different from budget, or whether it's due to the amount of materials used being different from budget, right? Different from our standards. So we can further analyze by calculating variances for each of those elements, direct materials, direct labor, and we could do it for overhead. But we're going to calculate a direct material variance and then a direct labor variance. Okay? So using that same information, we're going to break down the materials into a price variance and a quantity variance. Okay, so in order to calculate a price variance, we are going to compare the actual quantity at the actual price, actual quantity of materials used at the actual price paid, and we are going to compare them to the actual quantity used at what the standards or the budget says the price should have been for our materials. If we are comparing these two amounts, the only difference between these two amounts is going to be the price. One is using actual, one is using standards. Both of them are based off of the same quantity, the actual quantity, right? So again, using our information above, our actual quantity of, here we'll just go over here and use this. Our actual quantity of materials was 48.5 at the actual price of 8.10. Our actual quantity of 48.5 at a standard of $8 per unit. Really what we calculated here was the flexible budget, right? Actual quantity at the standard or budgeted price. The dollar difference between these two is $4,850. The actual quantity at the standard price, our flexible budget, was less than what the actual was. That is unfavorable. We spent more, 10 cents per unit more, than what the standards say we should have for our direct materials. That is unfavorable. Part of the overall variance is due to us paying more for our materials than we should have. But now let's look at the quantity. And to calculate the quantity difference, I'm going to multiply the actual quantity of materials used at the standard price. And I'm going to compare it to the standard quantity, the amount of materials we should have used for the units produced at what the standard price was. Actual quantity of materials, 48.5 at a standard price of $8 per unit. The standard quantity allowed, or the standard quantity that should have been used for our actual amounts produced. 8,000 units produced at a standard of $6 per pound. Our standards say we should have used 48,000 pounds to produce 8,000 units at a standard price of $8. Notice the only difference between these two numbers, one is using actual quantity, the other one is using standard quantity. They're both using the standard price. So the cause of the difference between these two is going to be quantity or volume of material usage. Actual quantity at the standard price was greater than the standards say we should have. That is also unfavorable. We used more to make 8,000 units than the standards say we should have. So now we have taken the total material variance and broken it into a price variance and a quantity variance. So two things are causing the overall variance in the material cost. This enables us to better drill down and ask questions and figure out why our price and our quantity exceeded our standards. Right? Start asking questions. Directs management's attention. Okay? And we can also do the same thing to determine how much of this total cost variance is due to labor. So go down here and we look at the labor, and we can break the overall labor into the rate variance, or the price we paid for labor, and the efficiency variance. How well we used our labor, the number of hours. So just like with the price for the materials, the rate variance is going to multiply actual hours used times the actual rate and compare it to the actual hours at the standard rate. Actual hours used, sorry about that, get that out of the way. Come on, get out of the way. Our actual hours were 15,700 at our standard rate of 16. Our actual hours at our actual rate, 15,700 at 1650. Actual at the standard was less than the actual hours at the actual rate. We paid more than what we should have based on our standards. That is unfavorable. Hours, or the efficiency, how many hours did we use? If I multiply my actual hours at the standard rate and compare it to the standard hours at the standard rate, how many hours should we have used to produce our units? Actual hours were 15,700 at the standard rate of $16 per hour. Standard hours, we should have used 2 direct labor hours per unit to make 8,000 units at a standard rate of $16 per unit. Comparing those two, there's a $4,800 difference. Actual hours used were less than what the standards say we should have used to produce 8,000 units. That is a favorable variance, right? Our workers were more efficient, so that is good. We like that. We're happy with that. Okay. So by drilling down into more of the causes by using our standards, we're better able to start seeing in total our actual costs we're over our budget. And so now we can start drilling down and figure out what the cause of that was. A good portion of the cause of that overall variance was due to our materials, our price being higher than standards and our usage being higher than what our standards say they should have been for how many units were produced. We can further drill down and see that in addition to the material issues, we also have a rate issue with our standards, right? Or not, maybe not with our standards, but we had a rate difference. We actually paid more than what our standards say we should have. Okay, so again, directing attention to where we might need to take corrective action. At the same time, it's also highlighting positive things. Our labor was more efficient. Okay, so if I were to combine all these variances, it would start to explain the total cost variance that the company incurred. Okay, we did not calculate the overhead variance, so there is another cause of this variance, but at least it starts to explain and help direct our attention to things that happened that were good and things that may need corrective action. Okay, all right, hope this helps.